Hi, I'm Mel Lopez, Chief Economist for ASEAN.
And I'm Peter Lundgren, founding CEO at Lundgren's Capital.
Welcome to Sound Economies with Mel and Peter, an East Meets West podcast by Lundgren's Investor Insights. Here we share what we're focusing at in economies and financial markets from the developed and the developing world. Hi, Peter. How are you? It's been a busy week, I hear.
Yeah, I'm fine. Yes, it is busy. We have all our funds are having general assemblies the coming days. So
Mm-hmm.
of course, there's something to prepare. Here in Denmark, it's the summer holiday season is coming closer as well, and there's all the stuff
Right.
that needs to be done before that happens. But
Mm-hmm.
as the coming all the coming investor meetings here, the general assemblies, we're really looking forward to them because it's nice to have a chat with investors and sort of meet them that way. So these are always quite good. So we're very happy. And what about you, Mel?
Oh, right. I'm also looking forward to those sessions with our stakeholders. And I'm also keeping myself busy as usual. There's a lot more to monitor as far as the global markets are concerned. Of course, we do keep an eye on a lot of developments, including a few surprises here and there, just like what we'll discuss in our podcast today. So, on the agenda for this episode
Yeah.
is China has this new policy regarding manufacturers of cars that they should use domestically developed chips for the car parts and especially the smart components of the cars. There's also a trend of a slowdown in listing activity across Asia Pacific. So we'll take a look at that as well. Crossing over to the Americas, Fed Chair Jerome Powell is basically thumbing down a rate cut in July despite continued pressure from his nemesis Trump. And then we'll also
Mhm.
mention our observations and takeaways as we look at developments in the Middle East, especially the Iran Israel conflict over the past 2 weeks. So, a lot on our plate today, Peter. So, I'll get started with my side of the world. Just last
Yeah.
week, there's a report that Chinese automakers are being told to use domestically developed microchips by 2027 as they build new cars. I think it's a
Mm.
very ambitious target, and it will drastically reduce or even remove car makers' reliance on US chips. So we know that most
Mm.
of the technology in China is powered by NVIDIA or Qualcomm chips from the US. But ever
Yeah.
since the trade war, it's also a sticky issue, and it is a big, potentially big disruption in the market since, so apparently some data here, a typical car, a fuel powered one, uses about 700 chips to
Mm.
make it. And then if it's a smart car, that goes up to 3,000 chips. So imagine the scale
Amazing.
potentially.
Yeah.
And Nikkei has reported that brands like BYD and MG Motors of SAIC Motors, it's a China-owned, a government-owned corporation, are
Mhm.
already looking at building cars using Chinese chips next year. So
Mm.
it is a bold move, although there have a lot of catching up to do because as it stands, less than 10% of cars made in China actually run on domestic chips. So the rest are really
Yeah.
imported. So big challenge,
Yeah.
exciting space for Chinese manufacturers of cars, particularly electric vehicles, Peter.
Sure. Yeah. So this is really, really worth for investors to dive into because it's a big thing
Yeah. Um,
for as a several counterparties both in US and China. So it is worth to spend time on. We would recommend, yeah. And I
right.
think it's a theme we will revert to depending on how it develops. Yeah.
Mhm. Right.
So
And
yep,
especially that
important
China is
issue.
taking a lion's share of the EV, the global EV market. So they're currently above 60%,
Mm.
I believe. So if they are able to convert that into domestic chips, That is such a big potential game changer as far as domestic manufacturing is concerned, Peter. So we're looking
Mm.
out for that. We're looking out if they can do a 100% coverage, but anything higher than zero is basically great for local manufacturers, Peter. Let me jump now to a more regional
Good.
view
Yeah.
across Asia Pacific. So, what we've seen over the past half
Mm.
year, 2025, as there's been a slowdown in initial public offerings across the region. We earlier
Mm.
expected a resurgence in listing activity for 2025. We said many podcasts ago that we expect this increase, particularly in the Hong Kong stock
Mm.
market, but companies are pushing back
Yeah.
plans. There is really heightened uncertainty mainly because of persistently high interest rates, elevated inflation, and of course, we've seen the tariff war escalate earlier this
Mm.
year, and that has caused more jitters in the markets. Um, IPOs actually across the region are on a 3-year decline since 2022. India has
Mm.
been quite a big market, beating the rest of the region.
Mhm.
But in general, it's really a deceleration that we've seen, Peter. Yeah, there is generally weaker appetite, especially for export-oriented companies. I could cite the Philippines as an example. So the Philippine Stock Exchange was expecting 6 listings this year. We've only had
Mhm.
one. So that's
Yeah.
last year that target was also unmet. Six was the target. There were three that went public last year. So it's a trend that's mirrored across China, across Japan, and South
That is
Korea
right.
even. So there's really the manifestation that there's a slowdown. So 46 IPOs in Asia Pacific for January to June, mid June. Last
Mm.
year, the full year figure was 174. So we'll see if they can catch up in the next 6 months, but it's looking like it's not on
Yeah.
trend so far.
No, they will have a busy second half. Yeah, if if that will succeed. Um, yeah, as you said, and in the start of the year, we were very upbeat here
Mhm.
at Longest, and we're really looking forward to look into a lot of IPOs, and it's exciting companies that could have been IPO. Let's put it this way. And certainly, it's turned out very different all of a sudden. People, and when we say people, this is where I sort of I'm a bit skeptical because people that is advisors, yeah, and it's also the sellers a bit. I'm challenging the views a bit. I
Mhm.
fully understand that export companies might not be the easiest one to IPO, yeah, because we simply don't know which way the trade wind is drifting, if we could put it this way. But anyway, a lot of other companies, they are absolute less, depending on different tariffs and tariff wars. I argue, and it's where I get a bit sort of critical, because we have had a period, a long period, also with almost a zero rate interest rate environment, where financial markets they were behaving very smooth, so to say. So they were simply in green every day. It was simply going up almost every day. And then it's very easy to participate in the financial markets. It's very easy to advise about the financial markets. It's very easy to advise about timing because you just say, I want to IPO in 3 or 6 months. As the precondition is, it's the market is behaving nicely, so it's not a concern. Now,
Mhm.
this is not that was an artificial period. This was that was not real life. But there's a lot of people who have grown up in that, believing this is real life. It's not. What we're
Mhm.
seeing now is basically market-wise real life. That we have some volatility that is initiated out of the Oval Office in Washington D.C. Yeah, okay, that is the source for some volatility. But if that source is away, then there will be other sources that are generating volatility. That is how a normal market functions. And what we're seeing here, okay, there's a shift. U.S. stocks are lower, and European, particular, and Asian and some Asian stocks are higher. That's an unusual shift, yeah, but it's just been so for many years the other way around. And now people are realizing that the U.S. is not the only thing to be fan of. You can also be happy for other companies around the world. What we're seeing is not high volatility, is not to be nervous about. That
Mm-hmm.
is normal market conditions. End of this long story is don't be afraid of doing the IPO because this is just a normal market. There are actually a lot of investors who have good appetite for new companies. There is a shortage of IPOs. There's a lot of money out there, and there are a lot of institutional money also who has be allocated to IPOs. We have seen some IPOs that have done really well with extreme oversubscription.
Mm-hmm.
So I would say to the advisors, to the companies, to the owners, to the founders, whatever, it's just go get started and don't be afraid of the world. The world is actually much better than we think. It can be that the growth rates are not that big, but if founders and the advisors they trust that these companies they are going to IPO, they are good quality, then there's also investors to buy them. So
Mm-hmm.
this is, I would say, less chicken and let this more a bit showing some trust in the future and their own companies. It's a shame, and there will be actually there's room for a lot of IPOs, and the founders could just go ahead. So this is the call from Long Greens.
Oh,
Okay,
actually, Peter,
you
what I've seen from latest data that we saw from PitchBook, for example, is that healthcare and consumer segments, as well as IT services or products, are the ones more likely to pursue or are very IPO ready in the next couple of months. I think healthcare is particular to the Asian market because there is bigger aging populations. That's something
hmm?
unique that is in demand because that's domestic, right? You take care of people, of your aging population through a domestic healthcare provider. So that's one segment
Yeah,
that is uh, maybe a silent winner, so to speak, amid this context.
agree. So yeah, we will look forward to study more IPOs for sure, and then see and look out for interesting companies in the market. So we are waiting. We are ready.
Actually, one of the concerns that are, that's being raised about not pursued IPOs is that interest rates remain high. So actually, it is a continuing debate as far as the US is concerned, Peter.
Yeah. To claim that interest rates are high, uh, ooh, it's a tough one. I know that the US 10-year interest rates is higher than we've seen long, but I would say most of the companies should be capable of earning money enough so it wouldn't disrupt any valuation in a big sense. Again, the world as we see it today is pretty much what we can expect. And okay, is a company slightly more less worse than hoped? It shouldn't let people stay away from IPOing anything.
Mhm.
So we hope that people will simply say, okay, they're happy, and they go for an IPO. Yeah, but
Right.
interesting is happening, and we will come back to that. That for sure.
We'll do maybe another check in a few months to see if people listen to your advice, Peter.
Yeah. We can always hope. We just need to have enough listeners.
Let's look at America, Peter. Another response from Fed Chair Powell after yet another tirade from Trump. So,
Yeah.
no rate cuts so far this year. There is some governors saying from within the Fed saying that they already
Mm,
support a rate cut by July, but Powell isn't sharing the same view.
yeah, exactly. Yeah, talking about the rates. Yeah.
Yes.
Okay, yeah, no surprise that Trump he is trying to bully for low interest rates. That was obvious even before he took the office. Of course, basically, the U.S. Central Bank is fantastic in guiding the financial markets. They are simply the best in the world, and it's admirable. They're doing a fantastic job. So Powell is forced to be pretty outspoken about what he thinks. And that is also a guidance of the market. The one thing is sort of the twist between the Oval Office and Fed. That is okay. But as the communication is so clear, then we've seen that there is no uniform approach within the Fed. And
Right.
it's we've seen that before. As the FOMC, the Federal Open Market Committee, they can be split on what they think. That is also that's seen before, and we know the hawks and the dows. But anyway, it is interesting to follow. Discussion is somewhat a bit more open and has been opened very much up. Uh, yeah, yesterday, as it became obvious that the Powell is saying the first possible move could be in September. And
Yes.
he's certainly not indicating a rate cut in September. He's just saying that could be the first possible. And again, the financial markets in general, they were very upbeat by the end of last year about the two rate cuts this year,
Yes.
and also pretty early in the year. And after all, we need to repeat, Mel, that here at Long Greens, we have all the time argued we could not see these rate cuts coming. So, so far, a pat on the shoulder once we were right. But and we still don't see these rate cuts. And if we look into what is Powell telling us, he is saying that the inflation is a risk, and it's not so much linked to oil. It is simply that inflation is not uncontrolled. It's not sort of finding a base, or it can spike up too easily. That's obvious for the Fed as well. So
Right.
that's basically the key argument. Yeah. And that is interesting. As of the IPO people, they won't get any help right now, and they won't get any help in the third quarter either. Yeah? So maybe they should sort of open up for for investors and get stuff done. Yeah. It is interesting as well because we know that the American economy is among the leading economies, one of the only ones that actually react on monetary policy. As
Mm-hmm.
the European economy is so slow that it doesn't react on monetary initiatives. It is so government ruled and influenced. But the American economy is still so private sector dominated that it actually responds on monetary policy changes. So we can also say, okay, uh, there won't be any tailwind from any rate cuts. And again, that is indicating that it's hard to see a U.S. economy moving strong forward. Yeah, let's put it this way. There's more. It's actually a bit more like a headwind. Yeah, from the
Right.
monetary policy. So there's sort of no indicators that there will be any strong shift in global growth either. GDP growth is what we see now is the best we can expect in the second half of this year.
Right.
Yeah, so it is. That can also include some good stories. We shouldn't be afraid of that. Yeah.
Right.
So that is probably sort of how we conclude on Powell, and but it's very interesting what has happened the past 48 hours actually.
Yeah, and another source of risk or hesitation coming from the Fed is, of course, the recent developments concerning Iran and Israel. So the conflict has escalated and tempered over the past 2 weeks. We did talk about this last week because it has been so disruptive as far as geopolitical issues and commodity prices are concerned. But now it appears that Trump was initially the one who actually broke the news that there's supposed to be an agreement reached, and it has held as of today from yesterday.
Yeah.
So
Yeah.
we should maybe talk about this more. What are key takeaways? What did we see from the conflict over the past 14 days, Peter?
Yeah, it is also interesting to see how also the reaction around the ceasefire and so.
Mm-hmm.
But what are our takeaways? It's a bit we touched it last week as well. Have we been nervous for a broader spreading war in the whole region? No, we've not. We've not. And if we look back now to the takeaways, the way that things has developed is also the U.S. calling Iran ahead of the U.S. bombing of the atomic factories and bunkers and whatever they have, and also stating that it is bombing solely. It is not an attempt to do any political change in the leadership in Iran. And we also saw that Iran very well ahead, long time ahead of the six missiles they sent to bomb the U.S. airbase in Qatar.
Yes.
Iran warned really well ahead, so everybody could be safe and nothing, as no personal damage would happen. It's sort of reactions that as a reaction that they need to do to maintain some sort of maybe domestic strength. But it is also, we see it as sort of a clear indication of nobody wants to escalate the
Mm-hmm.
war in the Middle East. And this is what we talked about before. There's nobody wants a war. As of course, Israel want to protect themselves by bombing the stuff they did do in Iran. But it's not that they're going for a classical war in that sense.
Mm-hmm.
And again, and we repeat ourselves here, that people living in the Middle East region, the Arab region, they don't want war. The countries are really running at a very high level. People live a very fine uh, upper and middle class life. They go out and have good times. They're happy for their homes. They're happy for traveling. They're happy for their life. They don't want more. They want the world as it is, and they want to spend money.
Of
Um,
course.
and this is very important because if you just go 20 years back, it was different, and if we go like 40 years back or 50 years back, it was very different. So we cannot just take a parallel to what happens, let's say, in the 80s and say, okay, it is just to for two Middle East countries to go to war and everything. No, nobody wants it. It actually could translate into say it's become more difficult for Middle East government to justify war
Mm-hmm.
because the people they just want a happy life, and this is I think it's a big component to take into account, and this is basically where we have argued since long. Nobody wants it. And this is also why we have been basically not afraid of a spreading war. We fully understand that if there's a crisis in the Middle East, the oil price goes up. That is a natural reaction. It's how the market works. And if Iran threats to block the Strait of Hormuz, the oil
Mm-hmm.
prices go even higher. 20% of the global oil consumption goes through the Hormuz Strait every day. It is amazing, and it is a very narrow street. It is actually pretty easy in the start to block it. After some days, they will have to fight with the U.S. Navy, the Fifth Fleet, and I know who will win. So that again doesn't make us so nervous, but there will be some disturbance. Now, this is natural, but sort of a general war is not what they want. This is basically what we stick to, and we feel confirmed. When we see how things has developed and happened the past 14 days, it is an indicator of nobody wants a war. And it's very hard to imagine that all of a sudden the war should escalate if nobody wants it. As you after all need to fight against somebody. Yeah. So this is our takeaway, and this is the view we have, exactly as Basically, the base view, as we've had all the time, is again an argument why we see the world is a bit more happy than
Mhm.
we might think. Yeah, and it is important, and maybe we should be a bit more happy, all of us, and see the upside instead of all the critical issues. That's another story. So yeah, so we are not so nervous, and we feel confirmed in basically the strengths, also in consumption in the area, in what people they want. The private households are strong around the world, and it's a key driver. Is our argument. So yeah, that was a bit of takeaway on that one. How are we? How are we feeling about the global outlook? Are we as happy as we say we are? Mel, tell me.
Well, of course, as we always speak our language, there are clouds in the horizon. Last week, we said that the brewing conflict in the Middle East, was an additional, cloud, a heavy cloud in the horizon, but it seems to have dissipated. The risk has
Mm.
dissipated, especially with the ceasefire appearing to hold. And oil prices have quickly adjusted down in reaction to that. So we did say that we were not as nervous as others in the market are. And that view has held. We think it is a short term disruption, but the long term view is really positive. As far as Asian markets are concerned, there are sources of strength within the region and growth remains strong, although there has been some sign of a slowdown. There is strong household savings, household consumption, private consumption that will support our positive view towards the markets, Peter.
Yeah, this is the way we see the world. Also globally, whatever part of the financial markets, we do still prefer overweight of risk. Meaning overweight of risk is U.S. Neutral. That is an old story now. We like non-listed investments, in particular in Europe. Meaning we're happy with risk. We're also happy with being positioned on the rate curve in the middle, and we're happy with the credit risk as well. I.e., we still see the world more positive, and also the financial world and financial markets than the majority. So this is a view.
It's great to hear the optimism persisting, Peter. That's all we have for this episode. Thank you, Peter, for sharing your views, and thanks to our listeners for tuning in. We'll be monitoring global developments and we'll share what's interesting in the next episode of Sound Economies, Mel and Peter on the Global Financial Markets, a podcast by Longines Investor Insights. Thanks for tuning in. For expert insights on the go, download the Longines Investor Insights app for free. For investors, we offer very exciting and high quality alternative investment funds, including our top rated Mutual China Fund. To know more, visit longinescapital.com.